The EU and India have reached a free trade deal after nearly 2 decades of negotiations. The agreement comes as the two powers look to offset President Trump's trade policies through economic ties. Now, European Commissioner President Ursula von der Leyen posting on X that they have, quote, concluded the mother of all deals. Joining us now is Seema Shah. She's Principal Asset Management Chief Global Strategist. Seema, thank you so much for joining us this morning. Lots to get to. First, we're waiting to hear from a response from Washington this morning. What could it be? What could we possibly hear from the administration in response to what's said, this mother of all deals here?
Well, it's going to be interesting how they respond. But I think just looking at the reasons for Europe and India to have this trade deal, I mean, firstly, this has been a long time in the making, so it doesn't come as a surprise. But I think it does tell us that you could see increasing a number of alliances between other countries around the world as we get used to this kind of multifaceted world where economies can't be completely dependent on the US anymore and really need to start thinking about their trade relationships with other partners.
Now, Seema, this also comes a week after we heard those threats on the EU over the potential, buying agreement to buy Greenland. We then heard the framework of a agreement has been made, and President Trump pulled back those tariffs. You say that Washington's growing reliance on tariffs as a geopolitical tool suggests here that trade policy volatility will remain within this administration as part of the framework or feature of the investment landscape. Do you think that this sort of plays out into the future narrative? Will we continue to hear different threats, tariff threats, after we heard that they're making this other trade deal on the sidelines here?
Yeah, I think we can expect this to be part of that geopolitical playbook, tariffs being repeatedly used. We've seen them being utilized even after last week to a number of other countries. But I think the key thing is that markets are really adjusting to this. I think they're learning a number of things. They're learning that firstly, tariffs don't have as much of an impact on growth or inflation as much as they had anticipated, partly because of very strong US profit margins has meant that companies can absorb it. But also that the Trump administration doesn't always follow through with those threats. So I think there's a number of things which are enabling markets to look through a lot of that noise, which has been the right trade. And remember, we have seen this play out last year where we had a number of very serious tariffs being announced, and yet the economy and the market performed very, very well. So I think markets are learning a lot from last year.
And Seema, one of those latest announcements that we got, another tariff threat, was that threat on South Korea, increasing that tariff from about 15% to 25%, large implications there for automakers, pharmaceuticals. What do you make of that latest threat and how that could fall out into the economy here?
Well, it's interesting that the South Korean market hasn't really reacted very much. I mean, there was a knee-jerk reaction, which was very quickly corrected. As is the case with a lot of these things, we need to wait and hear what the details are. Of course, if they are actually going to be followed through, there could be some impact, of course, for a lot of these markets. But ultimately, a lot of these companies have adjusted to the idea that tariffs could come through. They're adjusting their supply chain. So that dependence, again, on the US is declining. There will be an impact, certainly, if those tariffs go through. But I don't think that they would be as severe as maybe we would have feared this time last year.
And Seema, this is all happening as we're set to get some earnings from major U.S. companies, Microsoft, Meta, Apple, Tesla this week alone. You say that earnings remain the anchor here. Walk us through how investors should be going into these reports and what they should be listening for.
Yeah, sure. And I think to your point, we've had an incredible run up for markets. Valuations are quite stretched. So when we're looking at how total returns are going to perform for this year for equity markets, it really does come down to earnings growth. So that has to be key in terms of predicting where things are going to go. So specifically for these big tech companies, there is increasing dispersion. Investors are looking at the tech company, the tech trade, in a slightly different idea, suggesting that there's more focus on the balance sheet strength, on cash flows, and of course, what are the intentions on AI capex and how it's going to be funded. So we're expecting to see a lot more dispersion within the sector. That doesn't mean that the AI narrative is being challenged very much. It just means that investors are maybe starting to think through what are the differences between the companies. It's going to be very important how these tech companies perform, how their earnings announcements go. That's really going to set the tone for the market. But I would also say that, look, we are looking at a really strong macro backdrop for the US. That does suggest that earnings growth, not just in the tech sector, but along a number of different sectors, should be performing well this year. So from our perspective, tech can do well, but also we do think that there's a potential for broadening out to other sectors and actually to other countries for that matter too.
And Seema, on top of all this, we're also expecting to hear from Fed Chair Jerome Powell on Wednesday afternoon, expecting a decision on the latest potential rate cut hike or potential rate cut. It doesn't seem like they're expected to cut rates here, but you say that eventually we could see additional support from the Federal Reserve. How should investors be going into Wednesday meeting, and what are some key things that you would like to hear from Fed Chair Jerome Powell?
Yeah, I mean, I think there's a lot of focus on tomorrow. Just wondering how Jerome Powell is going to be, if there's any kind of response to the DOJ probe. We're not anticipating Powell to really talk much about it, but really to be focused on the interest rate decision. The market is, I think, predicting with zero chance of a rate cut tomorrow. Certainly that's our perspective too. But we do think that there'll be talk a little bit about the labor market and inflation, maybe taking on a slightly more positive tone on the economy and the labor market. But we do think that as the year progresses and maybe some of the tariff caution around inflation does start to fade around mid-year, that would open the door for one or two more rate cuts. So I think it's about keeping that door open whilst also conveying some optimism about the strength of the US economy.
Fed Chair Jerome Powell in the past has also weighed in on productivity gains, kind of alluding there to the impact of AI. Do you think we could hear anything on that front as well?
I mean, certainly I think this is going to be a key topic for the Fed over the coming months and years. Now, I think even if he doesn't mention it himself, there'll certainly be a question around it because the AI thematics and around the productivity gains, the impact to labor market inflation is going to be so key for central bankers to try and navigate when it comes to their policy decisions. Already we're seeing evidence of productivity growth in Q3 and Q4 already. So certainly that's a part of the narrative. It's probably quite early days for the Fed to be basing their policy choices on it right now. But I would suspect that this is a subject of a lot of research for the Fed, for the Bank of England, for ECB, for a number of central banks.
Seema Shah, thank you so much for joining us this morning. I really appreciate your time.
The promise of American has been we're going to sort of catch up with our competitors in premium. And did this quarter show that they're making progress in that catch up?
Thank you for having me on. I do think they absolutely made progress in the quarter in terms of what we saw with premium bookings. The fourth quarter itself, you did have a couple of hiccups, the government shutdown. In the Caribbean, you had some of the airspace around Venezuela closed for a couple of weeks. Right. If you kind of strip those out and you look at the guide that they put for 2026, it looks like they're making very good progress.
And they say first quarter revenue should rise by 7 to 10%. How does that comport with what you were looking for from them?
Yeah, we thought we were going to see something more in the mid-single digits, a little bit of a slower start. So the 7 to 10% is very good, and that's on top of 1.25 some odd points impact, for example, from the winter storm, where we're still seeing, of course, some residual effects. So when we think about the premium growth, what bookings look like in February or March, I think this is a very good setup for the rest of the year. And looking at how they're going to distinguish themselves between them and United and Delta, you have a lot more earnings growth in this name, for example. Clearly an inflection point if I've ever seen one.
Okay, so here's my question on that. So when you're deciding where to fly, when people are deciding where to fly, what is driving those decisions? And how is American sort of putting its finger on the scale, so to speak? Because I think a lot of people, when they are deciding where to fly, it's going to be price, it's going to be schedule, right? Is American improving that, or are they focusing on amenities, or all of the above?
Yeah, so look, price is still important. I would argue price today is a little bit less important than it was 20 years ago. If you look at the U.S. population, roughly 40% of U.S. households have annual income of $100,000 or more. That's 75% of air travel comes from that segment. So when people look to fly today, definitely schedule is important, what kind of amenities they get, how it's going to build in terms of loyalty program, and global capillarity. what sort of international and regional exposure do they have versus their competitors? How much of that metal is theirs directly? How much of that is coming from global loyalty partners? So all of those things, I think, weigh in. And today what we're seeing is an even bigger move in terms of premium. And that's where I think Americans making some exciting gains.
So what have they done to kind of sow the seeds for that?
Well, a new co-branded card program with Citi. That's getting the ball rolling in terms of them having some stickiness with core customers. 2 retrofits of existing planes and new equipment coming in that does have more premium seating. That's what is driving things today. And if you look at the network airlines versus the discount airlines, I think we really move away from that cattle car concept and cheap ticket concept, and now people want a nice onboard experience. And basically it's centered around who's buying. Is the broad consumer purchasing these tickets? Not really. As I alluded to earlier, it's relatively wealthy consumers are doing the flying, and they don't want a lousy seat. They want a nice seat on the plane.
Yeah, fair enough. You mentioned the storm, of course. So what do we hear from American on that front? And among the airlines, who was the most exposed to disruptions from this storm?
Yeah, absolutely. When I look at the FlightAware data, American was more exposed than others. You look at what happened in Dallas, Fort Worth, of course, and Charlotte. And then, of course, here in the Northeast, JFK and Philadelphia, American had a big impact. Of the big 3, they had the most cancellations in terms of a percentage of their daily service. They had over 9,000 flights canceled from this storm. Apparently, it was unprecedented in the carrier's history. And we're not done yet, because we started with a clean schedule for everybody, and now that schedule had assumed we would have equipment and crew where they're supposed to be, and they're not there. So this will be a couple of days to work through, but certainly versus the other carriers, American has been seen a lopsided impact from this storm.
Gotcha. Do you expect to hear some of the other carriers also talk about it, or is it really an American problem, to your point?
Yeah, so I think this disruption is significant enough that I'd be surprised if no one else talked about it. And when I sort of thumb through mentally the FlightAware data, for example, JetBlue was kind of up there. Delta Airlines was also kind of up there in terms of what kind of delays they saw. Maybe Southwest Airlines a little bit as well. But relative to DAL or American, Southwest, let's say they benefit from having a relatively simple operation. They just have one fleet type, and they're almost entirely domestic. So they don't have complicated global schedules that have seen some dislocation.
And speaking of Southwest, they report tomorrow, right? And they're also just ending their long-time boarding procedure. So what do you think is the future and outlook for Southwest?
Yeah, it's an interesting one. On one level, they have a formidable strategic shareholder that's been making important changes to the boarding process. They have strategically moving towards a look and smell that looks somewhat more like a network carrier. International code shares with different airlines. For example, changing the boarding procedure, no more bags fly free. I think if you're a Southwest, however, relative to the other 3, the main thing on my mind is the EBIT to free cash flow conversion. If we think about pre-pandemic, Southwest was doing $3 billion each of EBIT and free cash flow, for example. You look at today's EBIT to free cash flow conversion, it looks really poor versus what it used to. In fact, Southwest has been burning cash, whereas the big 3 have been generating free cash flow.
Can they get back there?
I think I think time will tell, how these initiatives play out. I think on the revenue side, it looks like they're on the right path. In terms of getting to more of a look and smell like a network airline model, seat mile cost is going to be the thing to watch over the next couple of years. As they onboard new equipment, maybe there's going to be nuances in pilot salary. Maybe they need new flight simulators, depending if they, assuming they go that way.
Right.
So I think the seat mile cost side of the fence is a big question mark. But the EBIT to free cash flow conversion that they used to have, I don't see them getting back to that. And then an opportunity to lever up, which they're doing. But I think longer term, we have to watch the EBIT to free cash flow conversion for Southwest.
Gotcha. Steve, good to see you. Thanks so much for coming in. Appreciate it.
Thanks for having me.
So, and this is before we even get into the reports on Medicare reimbursement rates, Jared, but just when you look at the numbers themselves, what to you holds the most responsibility for not just the disappointing results today, but the weakness that we've been seeing in United Health?
Hey, Julie, how are you? I think it's multifaceted. I mean, some of it is just stemming from prior year disappointments, and so this just adds another layer to that. I think from a sentiment standpoint, that's really important to consider. It's not like this was the first piece of bad news we've gotten for the industry or for the stock. When you look at the quarter, it was actually not so bad. The MLR was better than expected. There were some bright spots to kind of talk about. But then when you fast forward to 2026, which is more important, and then 2027, it just doesn't seem like there's that much upside to numbers. And that was really what a lot of investors were going on into earnings, was that you were going to see some shift in earnings higher and maybe get a conservative guidance with room for upside. And I just think that's sort of off the table near term.
And it seems as though Optum, which had been one of the sort of profit generation engines of the company, and it's sort of a subsidiary of UNH that provides pharmacy benefit services, but other types of services too. It seems like that is now shrinking. Is that also, I guess that's not necessarily unexpected, but is that something that also is going to mean things are going to be slower?
I think both sides of the business, big picture, are shrinking a bit. I think this is sort of United's approach in terms of, getting the overall business to better align with the cost structure. It's been very, very difficult, I think, for so many companies in managed care to predict the future. We've seen some really big numbers misses out of all of them pretty much over the past couple of years. And so it's not that distinct to see shrinking of the business. I think the profitability is okay. But again, when you talk about what needs to happen for the stocks to start working, I think we need to start seeing some real earnings leverage coming out of both pieces of the business, and that's just not happening.
Jared, taking a step back, right? When you talked about MLR, for folks who don't know, that's the medical loss ratio. It's the percentage of premiums that United Healthcare collects that it's paying out to pay for healthcare, and that has been a challenge for it and other insurers. Is there anything that these guys can do, something that would be good perhaps for all of us, to get the cost of healthcare down in a way that would help their margins? Are they working on that at all?
I think they're trying to. I mean, part of the 2026 number is a little bit more hemorrhaging of the patient population that's higher risk. I think the company is trying to downsize in certain areas of the market, which have been either problematic, difficult to predict, all of the above. And so I think that's already starting to happen. The MLR has been very hit or miss. There's been a difficulty or complexity with respect to predicting patient movement and activity. Not just United, I would say for most of the companies in this sector over the past few years. Some of that stemming from COVID, which put a lot more patients into the system following the pandemic. There's some typical demographic shifts, but this has been the toughest piece, I think, of investing in managed care, is that the companies haven't really had visibility. And if they don't, it's tough to think that investors do.
But if they're not covering the sickest people, I mean, maybe it'll be lower cost for them, but ultimately won't it be higher cost for the system?
It's possible. I mean, a lot of what investors are talking today about is, can United, can they kind of like shrink the cost structure what can they better do to align revenues and expenses? And part of that is cutting benefits. So I think a lot of the patients on United plans or otherwise are going to see, because of what's going on in the industry, they're going to be paying the same but getting less. I think that maybe from a societal standpoint, the most problematic piece of all of this is that you're going to see patients that pay X but get way less than they used to in the past.
That does seem problematic. Jared, and then there is the other big story that we are watching, which is that the Medicare Advantage reimbursement rates are now expected to be less than expected for 2027. How important is that for you? I mean, UNH is a huge company, so I don't know how important on a relative basis Medicare Advantage is. Can you help us understand that, and then the effect it's going to have throughout the industry?
Yeah, it's really important for UNH, for Humana, for CVS, and for a couple others as far as, what it does to numbers. I think a lot of the street models sort of implied or assumed that Medicare Advantage rates would go up next year by something around 5%, give or take. And so to see CMS come out and say that they were going to reimburse that category on a flat year over year, it just pressures earnings even more, right? Because the spending at the companies probably, the way that the companies are setting up for 2027, I believe probably assumes some sort of uplift in terms of reimbursement. Now that looks to be flat versus 5%, you're 15 to 25% of the business for several of the companies in this category is going to be impacted. Again, I think the number, it's tough to tell on a true numbers basis for a little while, because these patient populations on a per company basis seem to change a decent amount, but it's going to have a big impact. I think that's why for the next couple of years, even though United, I think, is being fairly assertive in saying that they're going to grow earnings, I think it's going to have to come from other areas of the business, including cost cutting, to get them there.
Jared, in having this discussion with you, whether it's about Medicare Advantage or about the fundamental business, I think we're all pretty aware that healthcare, the health insurance system in this country is pretty broken. We've had the discussion in Washington before, but it seems to be coming to a head in a different way. But does it feel like anything is going to change here?
I don't think so. Not over the near term. I mean, we talk about the brokenness of the system constantly. It just doesn't seem like there's an outcome that's going to happen anytime soon that allows all of the verticals within healthcare to act well simultaneously. So I think right now what we're seeing is a little bit of a thawing out in pharmaceuticals, arguably, with the drug pricing conversations having been had and some regulations going into place this year. And I think some of the discussion or discourse coming from DC is now squarely on managed care, providers, other segments of the market. I truly don't think there's anyone in the administration that's willing to, or at least has come out publicly and sort of blueprinted a plan that is going to, tackle the issue, recreate the healthcare system, what have you. So I think this is just an ongoing conversation we have.
Is there any reason for investors to look at these stocks?
I don't know. I think eventually, when you get these sort of visceral reactions to, single stocks and multiple stocks within a category, you let it breathe for a little while and then come back to it. It's really going to come down to what is the path for either a United or others in the peer group to sustainably grow earnings and show visibility. Now, I don't think we have that today. I don't think we're going to get that tomorrow. But I think one thing that's interesting is that the CMS Medicare Advantage final ruling will come out sometime in April. And so maybe there's a trade into April where you can go long this group for a little while in, aspirationally thinking that Medicare rates are going to be a little bit better.
Well, sticking with the airspace. The latest results from Boeing show the plane maker generated cash for a second straight quarter. Boeing also reported a 57% jump in sales as its recovery continues. Joining us for more, Tony Bancroft, a portfolio manager at Gabelli Funds, covering the aerospace and defense and environmental services stocks. It's good to see you, Tony, as always, to talk about Boeing. I know that you have been a believer on this one, so maybe validated to some extent by some of the numbers here. So what were some of your takeaways from what we heard from Boeing?
It's great to be with you, Julie. I think overall, progress on increasing production, getting the production lines in order, supply chains sort of battened down. And, I think over the long term, you're going to see these certifications, are going to be a big positive for the company. They talked about having both variants of the Dash 7 and Dash 10, which they talked about before this year, certified, and the 777 looks like deliveries are going to end up at the end of this year, hopefully the 777X. So these are all, positive momentum. Some a little bit of challenges still on the defense with the KC-46, so the new tanker program. They took some charges there. But I'd say overall, it's a pretty good quarter, a pretty good report, and looking forward to hearing what more of that to say on the call at 10:30.
Yeah, Tony, and it seems like that accounting change related, or that write down related to that tanker program, is what may be responsible for the stock going down, given that the other numbers that you mentioned look pretty decent. For people who aren't familiar with that, what is that sort of a legacy of what Kelly Ortberg, the CEO, is trying to sort of clean up? How much attention, how concerned should people be about that?
Yeah, the KC-46 is essentially a new tanker for the Department of War and international customers, and there's growing pains on every new program, and there were historically some issues with the boom. It's a new technology. How the boom operates much different than the boom that I tanked off of in the F-18. It's much more digital than historically, so more complex, and then some other structural issues, not safety of flight, but just essentially how the manufacturing process. They're working through those. Again, this is going to be a very long. My grandkids could be tanking off of this aircraft in a few years down the road. So I think overall it's probably not a big deal, and it's just some follow-on charges they have been taking on the defense businesses for the last few multiple quarters, but likely that's going to continue to improve. It's one of our largest holdings in our Gabelli Commercial Aerospace and Defense ETF, ticker GCAD, and it's done very well for us, and I continue to expect it will do well over time.
Tony, what do you think is the sort of biggest potential for upside with Boeing? We keep sort of waiting for them to work out the various issues that they've been trying to work out over the past few years. Once they do, is it just that being done that's going to be the thing that's going to unlock more upside for the stock? Or are you waiting for them to come out with some of the longstanding products, for example, they've been working on?
Yeah, I think that's, there's a couple of things there. I think the biggest is people still understand they talked about upping the 737, which is the most important program for them, to 42 a month. But still, they're not back where they were, at their previous peak of about 52 a month. And there's a lot of operating leverage that goes into production, as you have all this overhead. If you're producing at under rate, you've got these people working that are not at full production capacity, and you're essentially just paying for a line that's not optimized. So as that starts to improve and you start seeing more throughput, it's just going to increase the profitability. And it's a very simple math problem, like many businesses. And you're going to start seeing the profitability improve and the growth there on the commercial side, as well as the wide body business, the 787. You're starting to see more throughput there as well. They talked about eight a month, going to 8 a month now. And then the 777X is going to come online. and along with the other variants of the 737. So you're going to start seeing deliveries increase, and then the defense businesses are essentially incrementally improving and getting back to historic margins. So you're going to start seeing a business that was much more what we knew of Boeing back in the mid late teens. So I think that's sort of the driver. And then and then the follow-on program. Remember, there is a duopoly, and they have the follow-on programs for the next generation narrow body plane, which at some point they're going to start talking about and working on. And that's all things being equal with the we're seeing the traffic numbers and traffic projections for 2026 and beyond. It's still outpacing global GDP. So I think we're going to see some good things out of Boeing in the future.
Tony, while I have you, I want to ask you about another potential government shutdown, this one a partial shutdown. But are there any repercussions for defense spending?
I'd say I think that the defense spending, particularly right now, what's going on in the world, is probably a bipartisan issue, and I don't think either side of the House wants to see a holdup in that. I think that what happened last time was not a good look at anyone, and I don't think they want that again. And there's probably a way they're going to be able. There might be a short, a few day delay or a gap there, but I think they'll figure out have a solution relatively quickly, at least on the defense spending, to maintain that going forward.
Tony, thanks so much. Have a good day. Just taking a look at this quarter, the buyback, the dividend increase, it seems like investors got kind of most of what they wanted here.
Yeah, I would agree with that. I think into the quarter, there's been a lot of negativity on autos, a lot of geopolitical questions and tariffs, et cetera, and some worries about U.S. sales. Would it be down next year and all of this? And so I think these results, first of all, just on their own, they were great. Make no mistake. But even beyond that, I do think there was some surprise factor to the positive. It's probably showing why there's an outsized positive performance.
Yeah, it seems that way with that 9% increase. I mean, the shares were already running up into this report, right? We've already seen some increases there. So what does this reaction imply about now what future expectations are for GM?
Yeah, I guess I was talking about just the past couple of months, how the stock was trading. But I think it's a very positive picture. We've been talking about this now for a little while now. We're very constructive on the U.S. auto market. We don't think a car is a consumer discretionary purchase. Unemployment is at record lows. GM is also especially positioned because they have like 60-70% of large SUVs and pickups. We know that the strength of the U.S. economy right now is on the higher end, right? Not on the lower end. That actually benefits GM. They're doing this big buyback. There are a lot of things also that came out on the conference call, which I think are important. A lot of people are worried about memory chips, right? And GM said, you know what? Like, at least for now, things are okay. Right, they put it in their kind of commodities bucket, and it wasn't even the biggest element there. And then the other big story is EVs, which I'm sure you're about to ask me about.
I am about to ask you about that. I thought it was really interesting that Jacobson painted this as, well, the government was making us do it, as though there's no consumer demand. There is still some consumer demand for EVs. Do you think that GM has sort of right-sized or corrected the course for their EV strategy? Do you think they've done that properly?
I mean, I think they've really done a great job, honestly, in how they've structured their EV deployment. They were later, right, than let's say Ford, for example. They have plants that are flexible. That's really important, right? Because, for example, at Orion, they just, instead of making electric pickup trucks or what have you, make more ICE pickup trucks. That is a huge luxury to be able to do. And then, in Ramos, they're making the EV Equinox and Blazer, and they can just shift production to ICEs there. And so I think it's also a smart way they put together their EV strategy. They still believe in EVs, right? Longer term. I've been saying this for a long time. We did a lot of work on this. I think one of the big reasons why there's an EV slowdown, sure, there's policy, but it's also like you can get really cheap used EVs right now. Why would you buy a new one, right? So there's a huge glut of, leases from 3 years ago that are hitting the market, and you can get really cheap used EVs. I think that's a factor. There is EV demand. People do want these products. We'll get there, right? It's just right now, GM can very smartly shift production, and lower its EV costs. That was a big driver of their guidance that they gave, is coming from lower EV losses, and their 2026 EBIT guidance is coming in way ahead of 2025, and it could go even higher if we get a USMCA resolution. So I think that's really what folks have really focused on.
And Tom, as you mentioned, unemployment relatively low. Consumer confidence, though, isn't great right now. We know that the consumer spending that is happening because of the top income cohorts in the U.S. So what does all of that imply for vehicle purchases this year, and specifically new vehicle purchases this year? As you say, it ain't just EVs, right? You can buy used vehicles generally at a lower price.
Yeah, that's true. But, it's interesting if you kind of take a step back, right, and you look at the pandemic, and you look at the years after the pandemic, and you look at things like age of fleet, scrap rates, like how many vehicles are scrapped each year, looking at the past 50 years, and you extrapolate that, right, from pre-pandemic to today, you actually come up with a deficit of cars that were never purchased of about 5 million cars. Each year in the U.S., they buy around 16 million. So there's just a huge amount of cars that were never bought because of the pandemic. And like I said before, this isn't like McDonald's or Chipotle or whatever, right? You have to drive to work. If you have a job in the USA and you have to drive, you have to buy a car, and the age of the vehicle does matter, right? And for GM, they're selling cars more on the kind of upper end of pricing overall. So I think they benefit from this kind of higher end consumer benefiting, and the fact that the car ultimately, I just don't think it's a consumer discretionary purchase.
I mean, I took New Jersey Transit to work today, and I wish I had driven a car, Tom. On another note, for those of us who are relying on transit these days, would you say that GM is I know you have an outperform on a number of names, GM included. Would it be your top pick within the sector right now, or would you point elsewhere?
We really like GM, definitely, but our top pick is actually on the supplier side, especially suppliers levered to GM. One example is American Axle. This